Well, the Fed actually cut rates, but how did mortgages respond? Well, getting a lot of questions about that, so we'll update you next in this month's Market Update. Welcome into the Smart Mortgage Show. I'm Ben George with Bill Litton, Cross Country Mortgage. And Bill, we finally got the Fed rate cuts we've been talking about and many people have speculated about for some time now. And I know everybody's wondering, well, why aren't mortgage rates following? So I'm sure that's what you want to dive into this month, right?
Yeah. So, when the Fed cuts the rate, we hear from all over, all of our customers, realtors, friends that know that this is what we do for a living. They all reach out and they ask, hey, did mortgage rates go down with the Fed rate cut? And it's not a direct causation situation. Now, there is some correlation, but in the short term, it can actually be an opposite effect or an inverse effect.
Yeah, it's interesting because that's not, I think, what a lot of people just expect. Although we've kind of talked about this a little bit in the past, so obviously no surprise to people who have watched our videos before. But I know that the Fed met September 17th, so not too long ago, and they decreased the federal funds rate by a quarter of a percentage point to address the weakening labor market. So we kind of had that update, but I know there's still a lot of speculation, about what's going to come next. Will these rates continue to be cut? Are we going to kind of hold here for a while? So what have you seen and kind of what are you watching there?
So if you reference the Fed's dot plot, which is a survey of the Fed governors and where they see their Fed votes, the way that they think they're going to vote for the remainder of this year, it also goes out into future years, 2027, 2026, 27, 28. It does appear, just based on where things are today, that there would probably be two more rate cuts on the table in 2025, 25 basis points or a quarter of a percent each. So it's an additional 0.5%. And that 0.5% means that for this year, we could possibly see 0.75% in reduction. So a little quick history on the federal funds rate. So the federal funds rate before COVID was at 1.75%. Now, when COVID hit and the economy was shut down, how do we stimulate the economy? We bring down rates, make borrowing less expensive. So the federal funds rate was brought down effectively to 0 to 0.25%, the lowest that the United States has ever brought it down. Now, some countries actually bring it down into negative interest rates. We have not done that here. Hopefully we don't need to. But once inflation really started to heat up in 2022, 2023, they will quickly raise the federal funds rate to 5.5%, slow things down, quell inflation. Okay, that's the hope. Now inflation has started to come back down. We're in the 2% range. So the Fed feels like with a job market, the labor market weakening, we can support the market with lower interest rates. So we've now been taking the rates back down. Right now, we're at a federal funds rate of 4.25%. So where do we see it going? To answer your question, possibly two more cuts this year, although there's no guarantee because it's all data dependent, right? So if nothing else changed, that's probably what would happen by the end of the year. But we have an inflation number tomorrow. If inflation starts to heat up again, which we don't expect, but if it did, that could change the way that the Fed governors vote in our next two Fed sessions.
Yeah, something to keep an eye on there as well. And if you aren't watching us on YouTube, come on over and check out the dot plot on the screen for you so you can actually kind of see what that looks like. But Bill gave you a good breakdown of that. So what does this mean for 30-year fixed rate mortgages, Bill? I guess that's the question because we keep seeing rate cuts and we want that to translate over to mortgage rates. So people that have been waiting around for that lower rate, that sub 6, that number in the 5s, maybe even a little lower potentially down the road. I mean, that's what everybody's been hoping for. So what does this mean for mortgage rates moving forward?
Well, that's the most important question is how does the federal funds rate affect 30-year fixed rate mortgages as being the most popular type of mortgage? So again, the federal funds rate does not directly affect 30-year fixed rate mortgages. Okay. The federal funds rate is affecting more short term. So credit cards, home equity lines, money markets, but a 30-year loan is a completely different financial instrument. So the day that the Fed lowered the rate, I had locked in a lot of customers the day before, and I got some emails back saying, we shouldn't have locked. We made a mistake. And I wrote back, no, we didn't. We actually made the right move because the rates on 30-year mortgages have actually only increased since the Fed lowered their federal funds rate on September 17th.
All right. Good information here. Anything else you're watching in October, Bill? We're kind of in that final quarter of the year now.
Yeah. So what caused the increase in rates? Certain parts of the economy the economic indicators have actually looked a little bit stronger. Jobless claims, durable goods, GDP, all reported today stronger than expected. So that's what has correct rates higher. They have not skyrocketed, but they're creeping a bit higher, maybe about 1/8 to 1/4% higher since the Fed lowered the federal funds rate. So what we're watching for is this. We are watching to make sure that whatever strategy we apply to your loan is going to be the best for you financially. How are we watching the market, making the best decisions possible, and protecting your wallet and helping you pay the least amount of interest possible? Okay, so we're watching the market, applying the appropriate plan, and we have a really good track record with being able to put you in the best position possible.
We can start that process right now. Just text the word Lynn to 21,000 to get on Bill's schedule and begin talking about this. And again, that's where the conversation begins, where you can kind of start learning more about what your options are and let Bill and his team actually get a better idea of what your goals are, right? Your full financial picture beyond just, hey, I want to get into this house, and this is what the rate I'm looking for. Go much, much deeper than that with cross-country mortgage, and it all begins by texting the word Lynn to 21,000. So a little bit of good news, I guess, for rate cuts, but we'll keep an eye on where this heads because obviously it will affect things as we move forward, and we'll have the latest here on our market update. So please subscribe to the channel if you haven't done that already. We appreciate your support. Leave a comment as well if you have a question for Bill, and we'll talk to you again on another episode of the Smart Mortgage Show.
Thank you so much.
This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.